Picture this. You're walking a tightrope. On one side, you've got the immediate needs of your country. Families needing support, businesses that need a boost. But on the other side, there's this massive, towering pile of debt. Well, that is the incredible balancing act Italy is facing with its 2026 budget. It's a plan that had to somehow juggle tax cuts and new spending with one of the highest public debts in all of Europe. To really get our heads around this, we're going straight to the source. Our guide for this whole explainer is the document you're looking at right now, Italy's official draft budgetary plan. This is the government's actual roadmap, the one they sent to the European Commission, and it outlines exactly how they plan to walk that economic tightrope. And that really brings us to the central puzzle, doesn't it? How on earth can a government propose an 18 billion euro package of tax cuts and spending when it's already dealing with such a huge debt? Well, answering that question is exactly what we're here to do.
Okay, before we dive into the plan itself, we need to understand the economic battlefield, so to speak. So for part one, let's take a look at the very delicate balancing act Italy's economy is performing as we speak.
What's so interesting here is that you're seeing two completely different stories playing out at the same time. On the one hand, the good news. The job market has been remarkably tough, with unemployment hanging around historic lows. But then you look at the other side, the bad news, and it is impossible to ignore. Growth is sluggish, the economy is super sensitive to interest rate changes, and of course, there's that massive public debt.
And here it is, the number that absolutely keeps finance ministers up at night, 137.4%. This is the projected peak for Italy's debt-to-GDP ratio in 2026. Now, in simple terms, that means the country's total public debt will be almost 1.4 times the entire value of everything its economy produces in a single year. It's just a staggering figure, and it seriously limits a government's options.
So, facing that reality, what is the government's plan? Let's get into part two and see how they're putting together their 18 billion euro maneuver. So the plan is really a multi-pronged strategy. At its heart, you've got tax cuts for workers, more money for families and the national healthcare system, continued support for businesses to invest, and, increased defense spending. The key thing to get here is that this isn't just one big spend. It's a whole series of targeted moves across the entire economy. Now, a central piece of this whole thing revolves around something called IRPEF. For anyone not familiar, don't worry, IRPEF is simply Italy's personal income tax. It's a progressive tax, which just means the rate you pay goes up as your income goes up through different brackets. And it's one of these brackets that's the main target for the tax cut. And this table just lays it out perfectly. The government is proposing to drop the tax rate on that second income bracket from 35% down to 33%. The goal here is pretty clear, right? They want to put more money back into the pockets of middle-income workers, hopefully to get them spending a bit more and to ease the pressure from the rising cost of living.
But here is the multi-billion euro question. Where is all this money coming from? Well, a big chunk, 28%, is coming from rescheduling funds from the PNRR. That's the EU's big post-pandemic recovery plan. Another 22% is from a new levy on the financial sector. The rest is kind of a mix of spending reviews and other efficiencies. So it's not magic. It's really a mosaic of different funding sources.
Now, this plan doesn't exist in a vacuum. Italy is a major part of the Eurozone, which means it has to play by a very specific set of rules. So let's take a look at the EU's fiscal rulebook. And if there's one number you need to remember from that entire rulebook, it's this one, 3%. Under the EU rules, a country's budget deficit, that's the gap between what it spends and what it earns in a year, it cannot go over 3% of its GDP. And if you breach this limit, there are consequences. And those consequences, well, they lead to being placed on what you can pretty much think of as a fiscal watch list. The official name is the excessive deficit procedure. When a country is in this procedure, it's under a lot more scrutiny from Brussels, and it has to follow a really strict plan to get its deficit back under control. So a huge goal of Italy's 2026 budget is to finally get off this list. So given those rules, what is the government's official forecast? Part 4 is going to show us the intended path for Italy's debt and, hopefully, its growth. This is what they're calling the deficit diet. The plan projects that while the deficit is a little over the limit in 2024, it's going to drop to 2.8% in 2026, and that is crucial. It's below that 3% EU ceiling. From there, it's supposed to keep shrinking. This right here is the key to getting off that fiscal watch list.
But, and this is a really big but, the overall debt mountain, that tells a slightly different story. You'll notice that the total debt to GDP ratio actually keeps going up, peaking at that 137.4% in 2026 before it starts this very, very slow decline. It just goes to show you how incredibly hard it is to turn around a debt of this size. Even with a smaller annual deficit, the total pile just keeps growing for a while. And one of the biggest reasons for that is the dreaded snowball effect. This is basically the financial equivalent of trying to run up an escalator that's going down. If the interest rate you're paying on your debt is higher than the rate your economy is growing, then your debt will just increase all by itself, even if you balance your day-to-day budget. It is a really dangerous cycle that Italy is desperately trying to escape.
So what's the final verdict here? Is this plan credible? Let's turn to our last section, which weighs the chances of success against all the potential risks. Well, independent analysis describes the plan as a calibrated effort, which is, a pretty cautious nod of approval. But it comes with a big but. The quote highlights that significant risks are still out there, especially when it comes to actually implementing the planned reforms and being vulnerable to external shocks that are totally beyond Italy's control.
And this slide really spells out those risks in stark detail. A sudden shock from spiking interest rates, that could quickly push that debt ratio way up. What if growth slows down? That could push debt over 140%. If those EU recovery funds don't get used quickly, that stifles growth. And looming over everything is the constant pressure from an aging population on pensions and healthcare. Any one of these things could knock the whole plan right off its path.
Which leaves us with the final question. Italy's 2026 budget is this really ambitious attempt to thread a very, very fine needle to support its economy today while trying to secure its financial future for tomorrow. The numbers are calibrated, the path is set, but as we've seen, that tightrope is incredibly narrow, and the risks of a misstep are very, very real. The next few years will show us if the balance can truly be held.